So there are a lot of different strategies and different philosophies on how to use life insurance policies and what is the best one for me and when should I do what at what stage of my life. And I want you to know that this is not a video about the different types of life insurance policies. We've got other content in that area. This video is more about, hey, based off of what stage of my life, how can I best use my $1 or my $100 or my $1,000 a month to use life insurance policies to benefit me. More talking about it from a value proposition, less about which company or which product is better. That's not what this is all about, because everybody's philosophy is up to them. And luckily in the United States of America, we have the freedom of choice and you have the freedom to choose what's best for you. I just wanted to take something that may look complicated, maybe make it sound a little bit more simple for you and break it down a little bit. So first, I want you to look at the different variables, the three primary variables that your dollars are going to go to when you give them to an insurance company. The first variable is your cost of the death benefit. So there's a death benefit and it has a cost when you buy life insurance, whether you're getting term, whether you're getting universal life, whether you're getting a variable, or you're getting a whole life, or anything in between, there's a cost of insurance. And then there's another component when dealing with permanent policies, that's your cash value. That's the amount of money that's going into a separate sub-account, or it's being held by an insurance company, however they structure it, but it's not a cost, it's your money. And then there's this third that's going to be all the additional riders or different, what we call different options. Kind of like if you buy a car, you can get a car, but then you can get a lot of different options on the car or the engine or the inside and the interior. Same thing with policies. There's a lot of amazing benefits that are offered by many different life insurance companies about your income or about your living benefits or different things that happen to you at different stages of your life and bonuses that they'll offer you. And there's a lot of different variables. So let's take a step back. For every dollar that you're giving an insurance company, I want you to look at it like a triangle. There's a part of that dollar that's going to your death benefit, there's part of that dollar that's going to your cash value, and there's a part of that dollar that's going to some other things that you may have chosen to have on your account, which may have an additional cost or they may not have an additional cost. But what you're doing is, think of a Swiss Army knife. A Swiss Army knife has a lot of different knife options and magnifying glass and even scissors. But nobody would pick, if they needed scissors, nobody would pick a Swiss Army knife just for the scissors. It will do, and the tweezers that are in there may do, but we're not going to use, if we have a steak, we're not going to use a Swiss Army knife to cut our steak. But if we needed to, we have a knife, meaning what? When you get something to accomplish everything, it usually is pretty average at all of it. If you want to buy something specific, like, Jason, I want to maximize my death benefit, but I want to pay the least amount of money to an insurance company, I would say term insurance is perfect. That's a philosophy. There's even organizations that say buy term and invest the difference. Personally, I believe that that philosophy is now outdated, and that could have been the right thing to do a couple decades ago. But I think that there's some other options there. But, well, Jason, does that mean you own term insurance? I have a lot of term insurance. I love term insurance. I just believe in having term insurance and permanent life insurance instead of only accepting one. And so that would be one philosophy. There's other individuals that say, I don't want any term, I want all permanent. And that's okay too. You could do that if the cost of your insurance or the amount of money that you make or the amount of money you could put away, it could fit within your budget, because it's typically going to be a little bit more to have a big house than it is a smaller house. Permanent insurance is like having a bigger house, and it's like having a home mortgage payment where you're actually buying something that you own, where you're earning equity inside of it. There may be a time in your life where that makes sense, and there may be a time in your life where it doesn't. But I want to break it down a little bit based off of age so that you have a little bit more value. If there's anything that will kind of classify you into a particular category, the number one variable will be your age. Now, does that mean that a 20-year-old can't be experiencing the same thing that a 40-year-old or a 60-year-old is dealing with, or vice versa? Absolutely. I'll give you some of those examples. But traditionally, based off of your age, says a lot about where you may be in your life at that time. For example, I have two daughters under 2 years old. Both of them have a permanent life insurance policy. I put $150 a month into each of those policies, and the cost of insurance is probably $30 or $40 a month inside of the policy, and the rest of the money goes to their cash value. I want the ability to do a couple things. One, I love saving more money. Two, I love knowing that my daughters will have a life insurance policy because they got it as a minor. They'll automatically be insured at 18 years old and not have to go through medical underwriting. That's important. I want them both to have their $500,000 policy started off, and over time we'll see where that goes if they want to increase it from there. Also, I want to be able to control the money. I'm not in the business of giving an 18-year-old money based off of maybe what could some deem poor behavior. And I think parents should have the control to say, hey, there's an account set up for you. I set it up. I put my money into it. You will have some money here if you're good, or if you do your chores, or if you graduate school, or whatever it is that the parents want. But I'm obviously saying that while smiling at the same time. Maybe they go to college, maybe they don't. Maybe they get married, maybe they don't. Maybe they buy a house, maybe they don't. But I want to have tax-free savings, income tax-free savings for my kids. And I would say if you're anywhere from 0 to 20 years old, you may be in that season where you don't yet have assets, you don't yet have a huge insurable interest, but the compound interest works, especially if it's tax exempt, if you do it the right way to start when you're young. You might be somebody that's 20 to 40 years old in your life, and traditionally you're either A, leaving high school, leaving college, leaving the military, getting your first couple jobs of your life. You're probably working really hard and you're probably broke. This is not a stage of your life where you're typically killing it financially. Maybe you don't have a lot of money coming in. Maybe you've even started a family and you're realizing the cost of how much everything costs when you have children. I know I could tell you all about that later, but when you're 20 to 40, maybe at that stage of your life, it's really about you're also less expensive. And so you really want to put money away, and you're trying to put a lot of money into this type of policy because this is the beginning of your life. And maybe you're in a situation where you're making good money, but you're single and you don't have the cost that maybe somebody that has a family has. And you're looking for a policy to put a lot of money into it. There's going to be some restrictions based off the IRS. See your agent on how that process works. But you want to put money into this policy and you want your cash value to grow. You probably know life insurance is important to you, but you think you're invincible. You're 20 years old. You're 30 years old. You don't think about dying. You're not thinking about that stuff. However, we do know about drugs. We do know about car accidents. We do know about freak things that happen, and we all have a story of somebody that needed GoFundMe and thought they were invincible, but something happened. And I don't want to degrade somebody's dignity at the end of their life, and I don't want to put somebody's name next to a GoFundMe account if I don't have to. And I want to remove that and eradicate that, and I want to do it through making sure that people have policies. Obviously, there's a time and a place for GoFundMe, but I don't want it to be for every single time somebody that's low income or middle income passes away that we have to go ahead and do that. We could get these people policies a month after birth. We could get these people policies any stage of their life, and we don't have to be losing young people and not having the money to take care of all the things and the grieving in that process that follows. So anyways, you're 20 to 40 and you start a family and you get policies, you're probably getting a permanent and a term because it's cheaper for you. And you have an insurable interest, but you may not have the ability to put a lot of money away yet. Maybe you have all those costs and expenses we talked about. Then you've got your 40 to 60-year-olds where you're starting to make more money than you've ever made in your life. You also have probably more obligations than you've ever had at any other stage of your life. You probably are paying for kids or a house or a business or employees or staff or all these different things, or your life is just flat out expensive because if you're watching this video, you're probably trying to get ahead. And if you're trying to get ahead, you're probably responsible and you've got obligations and you care about your future. And so you're trying to put money away. And at this stage, you definitely are a prime candidate to make sure that you have permanent, that you have term. You really need all of it because you're also at this stage of your life people rely on you the most. You probably have younger children. You probably have parents that haven't passed yet, and they're relying on you, uncles and aunts, cousins. And so this is the peak stage of your life where people are relying on you the most. Now you get into maybe 60 to 80, and you're starting to think about the tail end of your career. Maybe it's retirement. You're starting to think that death benefit is even more important because maybe you've started a trust, and maybe you're starting to think about your kids and the grandkids. and you're trying to put some serious money away into these policies. These policies can be also very expensive, but these policies are very valuable to people that have estates and businesses, and they have a spouse, and they have family members, and they have people that are relying on them to be important. Or one day you want that, because I know that I want that, and I have that to some degree today, but I want to be a go-to person. And so where life insurance policies come in, death benefit becomes very important, because people are looking to preserve an estate and to use insurance as an investment. And so regardless of what stage of life you are, you probably know other people that need to watch a video like this. Maybe some people are a little bit overcomplicated, and they're like, well, Primerica is telling me to buy term, invest the difference. And, New York Life is telling me to buy a whole life policy. Or State Farm, Farmers, Allstate, they're telling me to get a universal life policy. Or then I talked to this agent over here. I talked to you, Jason, and you're a big fan of term and IULs and terms and IULs and terms and IULs. And I'm a big fan of term and IUL. I'm a big fan of blending these policies and learning how to do that the right way. And so regardless of who you're talking to or what's most important, make sure you have an insurance policy, and make sure you find out what the different types of policies do, because I've got 11 in my household, and I remember it started with one when I was 22 years old, and that became a habit. That enabled me to build up cash value. I used the money that I built up in my cash value to expand my business from Los Angeles to Dallas. I took money out of my policy, and I went ahead and I built a great business because of an insurance policy that was there for me. And it was the best savings vehicle for me when I was in my 20s and 30s. And it is now as I get into my 40s and go into my 50s. So regardless of what stage you are in your life, this could be a really good tool for you. Hopefully it helps you out. Go ahead and subscribe to our channel and like the video, share it with somebody that may need this, or reach out to us if you need any more information. Take care and God bless.